Hey, welcome back to the channel of Data Financially Follow. On this episode, we're going to be covering tax deductions and possible tax credits that are associated with home ownership. Now, I get this question a lot. Does owning a home actually help me? Honest answer, it depends. And it's not always what TikTok and Instagram make it out to be. Granted, I know I'm on here posting on it too. So always go talk to your financial advisor, your tax advisor. Always bring it back to the professionals. But basics are this. If I have a standard deduction of, let's just say, $24,000 over here, and my itemized deductions are $20,000, I'm gonna go ahead and take the standard of 24 versus what we have over here for our itemized. Go for the bigger one. Though, state standard deductions vary state by state, but in California, that standard deduction is half of what the federal is. Moral of the story is, just because I don't itemize on the federal return doesn't mean I won't itemize on the state return. And what pushes people into itemization is typically home ownership. That home ownership is associated with having that mortgage, and that mortgage interest is gonna be what's deductible, as well as property taxes. So talking about the mortgage interest deduction, prior to 2018 and then made permanent in OB3, was it reduced the overall loan limitation from $1 million down to $750,000. What this means is if I have a mortgage for $1 million, and even though I'm paying all this interest, a portion of that is going to be non-deductible mortgage interest. Only the interest earned on the first $750,000 can you deduct. If your mortgage is below $750,000, mazel tov. It's all deductible for you, granted if you itemize. Now, with that being said, once again, state law doesn't equal federal law, and always check with your tax advisor to see if this is applicable for you. But for California, it did not conform to that 750 limit, and it's actually still at $1 million. So going back to that previous example, if I have a mortgage at $1 million, federally, $250,000 of that was generating interest, I couldn't deduct it. But then on California, I get what was deductible on the federal side, as well as an additional $250,000. So always know there's going to be a difference between federal and state, and always check with your advisor to see if there's something there. Going to property taxes, prior to OB3, there was a SALT limitation of $10,000, which prior to 2018 tax reform, there was no limitation, there was no cap. This really highlights that tax laws are continuously changing and evolving. So this installment is really just a timestamp for 2025. And who knows what happens in the next 4 years. It might change. So with that being said, underneath OB3, the SALT cap is now at $40,000. A stark increase from where we were at that $10,000 cap. So if you live in a state with higher income taxes, higher property taxes, this is probably gonna be very good news for you. Because prior to that, you might hit that $10,000 just in your property taxes alone, or your W-2 withholdings. So having that $40,000 deduction is going to be a massive increase for some key individuals out there that have higher property taxes or are just paying a lot on their W-2 state wages. Also, depending on your state too, your vehicle tax, a portion of that is going to be deductible. In California, that's called our VLF, and you can go to a DMV website and just using your license plate and last 5 of the VIN, you can look that up. But that's for a discussion for another time. But that would go into that SALT limitation. Again, helpful. Then, speaking outside of our itemized deductions, the home offers other things. If you are a sole proprietor or a single member LLC, or even if you're an S corporation and there is an agreement between the company and you, the home office deduction can be a very powerful resource for you to kind of tap into. Granted, it has to be used mutually and exclusively for business. If my daughter comes in here and has her games loaded up on the computer, I have a pull-out bed right behind me for guests to come stay, we're using this as a nursery, it's not going to really pass muster in case of an audit because it's not meeting that standard of mutually and exclusive. Here's a really cool thing, but if we can meet this standard, then pro rata calculation of what the home square footage is and to the entire home, then you can start writing off a lot of neat things. Your utilities, if you have HOA, insurance, repairs, depreciation. all these really big deductions start coming into play, and then you can really take advantage of it to offset some really damaging income that are producing, higher taxes on your return. Once again, always talk with your tax professional, because there's going to be other things and mitigating circumstances that might dictate you might have some case specific deductions that are going to be applicable. But it's a great conversation to have. However, this one does get watched. It's not to be used and abused. The IRS has known this one to be abused, and they're on the lookout for it. So they're watching you. If you do this, be careful. Make sure that we're meeting those standards. And that depreciation, as much as we like to have it, there's always a caveat. Now, prior to OB3, we had the solar tax credit, we had home energy efficient credits, and these are no longer tax deductible for into the preceding years. So 2025, last year, to really kind of get this going and put those on the return. Moving forward, non-deductible, no tax credits, though. Tax laws change. Just because I'm saying this now doesn't mean in the future the laws won't change and this will come back to being applicable. So always kind of keep that in your back pocket and check with your advisor to see if this is applicable in your circumstance. Capital gain exclusion. So if you actually have your primary home and you own it and live in it, 2 out of 5 years, you can get what's called a Section 121 exclusion. That's $250,000 of capital gain exclusion for you. And then if you're married, also $250,000 for your spouse, for a combined total of $500,000. As I mentioned with the depreciation, we like it up until we don't like it. This does not wipe out the depreciation. So if you've been living in there for a long time, you've taken a lot of depreciation on the house, that 121, lowering your cost basis is going to be subject to depreciation recapture. But if it's never been used in the home office, this is your primary residence, you bought it at 1980s for $60,000, it's now worth $700,000, factoring, let's just say $40,000 of closing costs, you'd be looking at a potential $600,000 of capital gains. But this 121 comes into effect, and instead of that 6, it's really $100,000. So it's a really powerful tool to go ahead and not have to realize all the gains that we would have to. And then if it's a rental property, you also have Section 1031. These exchanges are extremely powerful, and I'm going to do a whole other segment on that, but these are just avenues that you can kind of really tap in with home ownership, whether it's a personal or primary residence, to get away from the capital gains tax and that exposure leaving you in a less not as well off position. Things you can't deduct. You can't deduct your down payment. When you sell the house, you can't deduct what was paid back to the mortgage company. HOA fees in most cases, unless it's associated with a home office. Home improvements, just because they're expensive, you can't deduct that. But once again, maybe tax laws change in the future and maybe I'll come back into it. However, for most people, home improvements does not factor in. Though if you do sell, then you're gonna wanna keep track of those home improvements because those increase your cost basis. So más importante to make sure that we keep track of those receipts. So the big takeaway here, homeownership can provide substantial tax benefits. It's a tool, and a tool is only as good as you know how to go use it. And that asset can yield significant tax savings if used appropriately. Assuming deductions apply when they don't doesn't help you. So always, go in there educated and talk to your advisor. Missing credits when they actually do apply, and making decisions based on tax myths instead of tax laws. So if you're buying a home, upgrading, or planning to sell, those are moments and time which are great to connect with your advisor and see what we can do. Don't wait till after the fact. Once you start thinking about it, plan for it. And that's really the point. It's not just about owning a home, it's about owning it intentionally. Thank you for tuning in, and I can't wait to connect with you next time.